Give us a sense of your take as what was behind these gyrations that we've been seeing on bond markets in the last couple of weeks.
Well, some of it has been technically driven. We had some auction and some liquidity issues in the market that were spiking up. But I think, in general, response to the substantial fiscal package that's being passed as we speak in the U.S. And so, it's not surprising to see, bond rates tick up modestly in this environment.
Yeah, so Kim, that brings me nicely to just talk about how much of this is stimulus based on sentiment, the fear of inflation, which might result from this, or how much is it also down to structures in the market which perhaps make it quite fragile to any changes in liquidity as well as funding requirements as well?
Well, we think it's probably a bit of both. I mean, over the long term, we are actually not concerned about a runaway inflationary environment. We believe that inflation, is likely to tick up modestly over the cyclical horizon, but there's important factors in terms of fiscal fatigue after a while, in terms of demographics, in terms of technological disruption that we believe will probably keep inflation contained, and we won't see a situation like we saw in the 1970s.
Yeah, so Kim, I mean, you could draw, I suppose, some comparisons to perhaps what happened in the bond markets just during the whole taper tantrum, but I'm not going to go there particularly. But give us a sense of how that informs you as to what's likely to happen this year. And also, what about the trends that you're seeing, especially in fixed income, through 2021 now?
Mm-hmm. Well, I mean, I think what you'll see is just a lot of volatility in markets. Certainly we believe that, confidence is improving, particularly with the vaccines coming online, that you will see an uptick in growth globally, particularly in markets like Asia that are coming back online, and then certainly in the US and UK who are rolling out the vaccines at a much quicker pace. And so a lot of reason to be confident in the market, but a lot of this is also priced in. And so it's important that I think we look at, what are the risk factors to the downside. Still a lot of volatility with respect to how the market will ultimately recover. We talk a lot about, potential long-term scarring as a factor of the COVID crisis that we have not yet realized the full benefits of or circumstances of. And so in all, we have a more sort of cautious view on the market, and we're seeing clients do the same thing. So it's been interesting in terms of the divergence. A lot of our institutional clients have taken this more cautious view, I think recognizing the uncertainty and volatility that lies ahead. On the individual side, particularly here in Asia, we've seen a bit of a barbelled approach. Last year, we saw a lot of clients remain in cash amidst the uncertainty. This year, we're seeing sentiment improve, but still, again, a little bit of barbelled response. Some clients remain in cash. Others are very much risk on, in line with the confidence that they're seeing in global markets and are focused in areas like emerging market equity. So you're definitely seeing a difference in terms of how clients are allocating capital in this environment.
In the bond market, Kim, where are the opportunities? On the one hand, we talk about the massive volatility in the bond market, but when you take a look at China, it was pretty stable. Some say it is a haven now. How do you view the Chinese bond market?
Sure. Well, I mean, I think that's what's one of our biggest areas of focus is Asian credit in particular, of which, as you know, China comprises about 50% of both the high yield and the investment grade market. So China is a driving force there. We have thought that market looked attractive on a relative value basis versus US and European markets. A lot of our clients were seeing strong investment in that area. So we continue to be positive on Asian credit and China credit in particular. As is always the case, though, it's all about active management, and it's about sussing out where the top performers will be, and avoiding parts of the market that we think will be more difficult, and that goes true for China as well. But we do have some confidence there and are continuing to allocate for our clients.
Were you disappointed with China's GDP target of about in excess of 6% when Pimco was forecasting 8%? Could that mean perhaps the economy is plateauing in a way, and that could mean sustained stimulus for developed economies?
Well, we definitely think there's going to be sustained stimulus for developed economies. I think the lower growth rate in China just means that they're very cautious on making sure that they don't have overheating within their own economy, and they're quite focused on making sure that they have sustainable financial markets going forward. And so, focusing on areas that perhaps are lower quality, shoring some of those up, and just making sure that the economy as a whole is running at a sustainable pace. So all of that we think is positive, but we also think makes for other reasons global stimulus still a going concern across most of the world.
But credit growth in China is already tapering. What risks do you see?
No, I think you're right. We definitely see the credit growth tapering there, as you note. But we're also, I guess, more focused on places where, we've seen stronger balance sheets. So, some of the SOEs and things like that, are perhaps in worse shape. And so, we're looking at, other, banks, financial organizations who do have stronger balance sheets and can weather some of these storms, more thoughtfully than other parts of the market. So again, being quite, differentiating in terms of where we allocate.
Kim, perhaps as we come out of this pandemic, we're in a unique position to reshape things. And, what can be done now and what can be put in place to bring women back to the workforce in a more egalitarian sense and shape perhaps a more equal future here?
Mm-hmm. Well, I think we learned a lot through this period, and while I think it has been taxing, particularly on women, we haven't seen some of the data yet, but we know that all of the stresses of educating children at home and having to work in an at-home environment likely has been more of a pain for women, and so we have not yet seen the data, but we would expect that maybe this has caused more women to leave the workforce. So on a short term, this could actually be a negative impact, which we have yet to see flow through. But over the long term, I think it is much more positive for women. The fact that we've been able to test and prove a work from home environment, which has necessarily extended flexibility to women, which can be a key driver of retaining them in the workplace. So we've done it now, and I think a lot of this is going to persist going forward. That will make our talent pool a lot more resilient and inclusive in terms of ensuring that women stay in the workforce. So perhaps a short-term deficit, but over the long term, I think all of these things are really positive towards a robust female workforce.